I personally think the next one's going to be a Nigerian payments app called Credite. You can write that down. I think that's the next one. I'm pretty sure.
He's selling his own book as well.
And then I think right after that is going to be Anda, who's here.
Again, selling his own book.
And in LatAm, it's been about 40, about a little less than half of which have been unicorns. So if you're unicorn hunting, which is what I'm doing, you need a large sample set. Otherwise, you might miss the one or two that are going to come out of Africa, or however many are going to come out of Latin America, which are my two main focus markets. When it comes to supporting portfolio companies, my background is heavy Wall Street. I spent 30 years there, 24 at Morgan Stanley, and I have a deep credit, derivatives, deal structuring background. So I tend to lean on that. And that's how I get into deals, and that's what I'd love to meet every founder in this room before the end of the day. So one of the things I do, not to AJ's horn, but a lot of times when there's a company that's doing some kind of embedded lending or some kind of financing, obviously the first stage is your friends and family, and then you look around and see if you can find a local bank in currency, and then you look around for private wealth or for DEEQs if you're in Brazil or something along those lines, and you look for maybe a DFC, but if you can't do that, then you need a debt fund, right? And a lot of times what I will do is I will help the firms that I'm talking to figure out their financing choices and how to stay out of trouble. Being a guy who ran a credit business at a major bank, I obviously have a lot of experience with workouts, and I've seen what gets people in trouble, what covenants are not good, how to stay away from lend to own type lenders. So a lot of times I'll introduce people to AJ. I have other funds that I work with as well. Usually my second and third choices, obviously.
Thank you for that.
But what I try to do is really provide the expertise on what can go right and wrong when you're using leverage in your business, right? I made this joke last time I was here, and I make it to everybody. I think taking on debt is like getting married and divorced at the same time. Think about that for a second. I think it's actually true. So that contacts the normal stuff that a VC will do. But I'd love to meet anyone here who's raising right now or thinking about raising. That's what I got.
And you're running Funtes QED's seed stage for Latin American fintech fund. What are you looking for when you're deciding if a fintech lender can go actually beyond seed stage? And how is QED supporting its seed portfolio companies through mentorships, playbooks, follow-on capital to ensure that they successfully bridge to Series A and beyond? It's a very interesting contrast between Brian and what QED is, because he's we call him the Lone Ranger in emerging markets, because he runs his own shop, and QED is obviously a much bigger institution with a lot of fingers in a lot of different pies. But tell us.
Yeah, absolutely. I do look over content, but I would say that's one of our strategies, and now we've evolved to I cover a bit of everything. So QED primarily is Series A, Series B investing, and we do have a growth fund, so we cover the whole spectrum. But our sweet spot, I would say, is Series A and early Bs. And we do have our origins at QED are in lending. So Nigel Morris, who founded Capital One, founded QED, and he loves lending, and we've never shied away from investing in credit because that is what many of the original partners at QED came from, and it's in our DNA. So I would say that has always been a differentiator, I think, because as we're going to talk about, VCs tend to relatedly not love credit and not understand credit, and one is because of the other. And so I think given that we do understand it, we do like it, we know how to build it, we have a lot of lending companies in our portfolio, and so regardless of seed through Series B, we actually are able to help companies depending on where they're at. So from an earlier side, we help them build those relationships with the first step providers, or guide them in, okay, what should be the metrics that they're going to be looking for, what does your loan book need to look like in terms of size, start making the introductions, help you run a debt process, help you evaluate debt term sheets, right? For many founders, it is their first time going through this process, and we're able to provide that experience, if you will, and also connect them to, we have a portfolio of over 150 companies globally, so chances are that we've seen more than one company building in a similar space, and so we're also able to help connect within our portfolio so that founders can learn from others, benchmark against others, right? What are you seeing? What were the terms that you got at this stage, and so forth? And so I think all of that is very helpful. But at the end of the day, I would say for lending, we tend to want to invest more at the Series A, Series B, because I think there is a bit of a science to it, right? Like you want to see that you are able to lend. It's not just a talent and a team thing, but I think it is a matter of, let's see your metrics, let's see your losses, let's see that you know how to scale a credit business, and that you know how to manage risk, right? Because at the end of the day, you're manufacturing risk. It's not just risk that exists, so you need to be able to manage it. So I would say for us, a lot of our lending companies tend to invest once they're a bit more mature because we know what we're looking for and we know what they need to go beyond that.
So what are some of the red flags or green flags? So let's say Bride's gotten in there super early. We've been working with them also. They're getting ready for QED to lead the round on the Series A. What are the things that you think are, oh, this is super cool, we're highly supportive, or one of the things we're like, nah, we're gonna pass?
Yeah, for sure. So having Brian there is a green flag as
Yeah.
an investor.
I agree.
So I think the broader point is having somebody with experience, right? Or either the founder themselves or being advised by somebody that knows credit is a definite green flag. We see a lot of companies that don't have that, and so that is a red flag. And then two, I do think it obviously depends on the business model, but I think what we want to see is that you know how to lend, right? And so what does that mean? Depending on who you're serving, right? If you're business lending, if you're consumers, what is the performance of your loans, right? Like what's the size of your book? What are your losses look like? Have you been able to raise debt? I think that is a big green flag, right? Being able to raise debt, because not everybody can do it. And I think very few are able to do it at like the seed stage. I know a couple of people here have done it, and I think that is a green flag. And if they're working with you, then I think that is a good indicator. But I think from us, from our perspective, it's not just a moment in time of, okay, you're doing well now, we're going to fund you. We need to believe that this company is going to exist for the next 10 plus years, right? And that you're going to build a sustainable business that can eventually be worth maybe up to $5 billion, more than $5 billion, given the size of our fund. So for that, we need to believe that you will be able to operate a lending business at scale, right? And that means you're going to need deep capital, deep pockets in terms of debt funding, right? Not just equity, but especially if you're lending, like you're going to need to access and tap into institutional funding later on. So I think that's what we're trying to assess, especially in emerging markets, right? And we very much are looking at Mexico, Brazil are different, right, in terms of what you can tap into. And then obviously if you were later on able to access the US capital markets, that's a very different story. And that unlocks for us, okay, you've shown us that you can build those relationships, that your business actually translates well into some of those capital markets versus relying only on local funding. And so that's a little bit of the gist of it.
So Gabriela, Lucha is not actually your typical fund or accelerator, and Gregoire as well has got a very similar, or there's a little bit of a commonality between the two of you. I'll go with you first, and then we'd love to hear you to chime in as well. But you guys tend to co-create solutions, with impact-driven founders, and you do that through this fund called LUCHA NP. How does that work? And what is the co-founder's hands-on style engagement? And how are you helping startups get to the point where they can talk to QED and talk to SixPoint, for example?
Honestly, I don't know what I'm doing here. But I'm trying to make sense of what I'm saying, as I am. And the weirdo of the bunch. We're not an accelerator, we're not a BD, we're not an education platform, we're not a fund. We're all of the above and none of the above. So we call ourselves your impact co-founder. We do not invest in startups, we partner with founders. Because we go in partnership very early stage, we have to look at the person, not necessarily the business model. We work very hand by hand. We're actually co-founders. So we take a lot of stake, which is wonderful. And we are early exiters. So our strategy is to go very early. I try to just went out of there before Series A. So we have 20 people in LUCHA, 25 already. And we have a dedicated team that works with the founder to build something. So sometimes it's just an idea when they come into LUCHA. Sometimes it's an MVP, sometimes it's a broad stage. We have different structures that actually can go by with the founder in every stage of the way. For example, they come with the idea, we have an accelerator. They come with an MVP, we have an impact studio, where we build something to go to market. We do already MVP and into the market, we have an equity fund. We are already receiving equity. Most of the times we are the first institutional ticket. And now we are designing, against your desires, a debt fund. So we're trying to fund impact startups that are not greenwashing, and we have to make the differentiation between real impact founders and the ones that actually say they are impact founders. So just for example, buy one get one, it's not impact. This is greenwashing. So there have to be true motivation within the founder to actually be considered impact. And I already said this in the morning, I'm gonna say it again. And I haven't asked Carla if that's okay for me to say, but I'm gonna say it as well. The head of 60 decibels for Latin America, it's Carla, which is sitting there. And he was one of the co-founders of Lucha and the one that designed our thesis, our impact thesis. So we're very rigorous within the measurement of how we measure impact. So it's not greenwashing, it's real impact measurement. I forgot what the question was.
That was great. And it's actually a good segue for Redwap because you're also, with your consulting business, you're getting in super early and you're actually helping founders go from that to MVP. You want to talk a little bit about that and how do you evaluate leading into a particular platform? And again, not to single out QED, like when you look at them, you're like, okay, these guys can actually post up and eventually get to talk to guys like QED and guys like us. Like, it's a nice parallel with Lucha.
So my background is really in the people business. I worked in banks, but with private clients. So I tend to know how people are. And what is great in our world is that we are all humans and we react. Despite our cultural differences, we are all about the same when we talk about. So what I like when I invest, so I invested in probably 80 startups, very early stage. Revenues are probably between $0 and $10,000 a year when I invested, so it was really early stage. I like that because I invest in people. And that's probably our common ground. But what I like the most is to help them or try to help them to go to other guys that are later stages, because most of them, of course, I have to differentiate between the fintech startups where people should know a little bit about finance, at least should, and the rest of the startups where usually the founders have no clue about financial. What is cash flow? They don't know. So this is also part of my business, is to educate them on the financial side. But more importantly, I think most of them, fintech or not fintech, don't understand the word governance.
Yeah.
What I want to say is that the governance is really key, because I'm still part of the family when I invest with those guys, because it's very early, as I mentioned before. But when you go to real guys like funds, VC funds and everything, they are not nice. So they have to understand, sorry for the VCs that the founders have to understand that the governance is key, that you have to have processes in place. Because they're gonna ask, the VC gonna ask, what is your board? Is your board you and your brother? No, it's not gonna work. So to me, that's very important, and that's what I do.
We do some of that as well as part of the sort of the advisors with the checkbook mantra that we try to practice. When we're getting involved with platforms, corporate governance is non-existent, and we try to help them get that, because you've been through this process with us.
Yeah.
One of your portfolio, with two of your portfolio companies actually. So with that in mind, I wanted to jump to Suneel for a minute. VentureSouq is a really interesting bird, as they say. It started doing super early stage investments globally, and as you've grown and raised more funds, you've now gotten more regionally focused. You're going later stage, but you obviously have legacy early stage investments. And it is really interesting to see how not only VentureSouq has evolved to now look at deals in the same vein that QED looks at deals at that stage, but you've obviously been to the journey that Lucha and Brian have been to before. And talk us through like how you've seen those early portfolio companies fare and why the shift. And also, I think there's, again, because of geo proximity, this is more heavily weighted in LatAm. You have some LatAm investments, obviously, but you're now very focused in the Middle East. Talk us through what you're seeing the differences between the Middle East ecosystem for fintech lending versus LatAm, The other thing I would tee up for you is we're doing our conference in May, again in Dubai. There's very little LatAm representation in the GCC. They just don't come. Like the LatAm fintech lenders and LatAm fintech focused ecosystem just don't show up in the Middle East. How do we change that? How do we get the Middle East guys to look at LatAm in the same way they might look at Southeast Asia and India and potentially even Sub-Saharan Africa? That's a lot of questions.
Sure, I'll start after you get it. So yeah, as you pointed out, we did it, for lack of a better term, ass backwards in terms of our strategy. So at the time we started deploying capital, it was roughly 2000, call it 16, 17. There was nothing going on in MENA. We had very little in terms of startup financing. There were no exits. There was no path to exit. And we could talk about where that's evolved to now. And so I used to work at a large wealth fund, so did one of my partners, and then my two other partners that were fairly well connected in the US. And so we had good deal flow here in the US and kind of adjacent markets like LatAm and going over to Europe and Asia, other kind of hotter VC ecosystems. And so we started investing in those markets because that's what our investors, which are primarily large financial offices, that's what they wanted. They wanted the hottest deals in Silicon Valley and other similar ecosystems. And so we started doing that, and then ultimately we deployed a significant amount of capital through that strategy over 3 or 4 years, and then decided around 2020 what we were going to do as VentureSouq as a firm. What's our story going to be, or what's V2 of what we're building? And so we'd ended up making a number of fintech investments in various markets, including US, LatAm, Latin. We can get into LatAm in terms of why it's an important market for us to gauge what's happening in MENA, almost looking ahead. Then at that particular point, we took all that data over 70 fintech investments we made at a very early stage and started building a thesis on MENA. And then, of course, COVID hits in 2020. Those of you who had been to Dubai and Riyadh before 2020, it was completely analog. It went digital very quickly, and that was our opportunity. And we decided to drill down into fintech. We also look at fintech as a foundational layer of the emergence of any ecosystem. It's like e-commerce penetration, and then financial services makes up such a big part of every person in business's life. So we decided to just go into that and really focus on that. And for us, we used all that data, started building a platform, and now we're 2 funds into a MENA fintech strategy. And at the exact same point, you could go on forever about this, but the ecosystem started to develop because we had a lot of our sovereign players, public investment fund, and all these big funds started to back local companies. These firms and institutions had backed some of the biggest companies and infrastructure globally in every city, in every geo, and now they're looking inward and saying, okay, we're going to fix the financial services problem here. And so fast forward to us in terms of where we're at now, going back to, I guess, one of the parts of your question around looking at MENA versus other things. There's a lot of similarities, of course, and we track LatAm and to a certain extent Southeast Asia as markets we look at to try to figure out what we think is going to happen in MENA. If you take LatAm, for instance, just like MENA, it's not a unified market. It's not the US. It's not in the US, you can build something in San Francisco, you're selling in Texas and New York a week later. It's not the same thing. It's a fragmented market, a collection of 10, 12, 15 countries that make up a geo, different regulations, different politics, but very similar or strong similarities in terms of culture, language, and religion that kind of weaves through the entire place. And so we track LatAm and to a certain extent, again, Southeast Asia, to figure out what's going to happen in MENA. I think MENA, there's positives and negatives to every single market, but I think with MENA, what's interesting is you have levels of underpenetration, particularly in credit being one of them, where there's still massive opportunity. Just if you take the UAE alone, I think UAE banks lent in 2025 something like 350 billion from banks alone. Only 5% of that went to SMEs. So SME financing is a massive gap.
Yeah, the credit penetration, we use these statistics all the time as well. You look at credit penetration within global EM, it's in many countries sub 20% of the population, but mobile telephony penetration is
Very high.
very high.
Yeah.
And then you layer on top of that the age demographics and the various age cohorts, and you can see the youngest age cohorts are just coming into the time when they want to access formal credit for the first time. So it's a perfect storm.
And we look at that as an opportunity. And you couldn't, if you know anything about the Middle East, the net interest margin of the top 10 banks in the Middle East is probably twice as high in the US. They're very profitable.
Yeah.
So all these banks, they didn't want to get into the business of lending to SMEs. They were too busy lending to
There's
governments.
also regulatory.
There's some regulatory issues, but they were making so much money lending to the Aramcos of the world and the governments of the world, and they'll always get their money back in this super profitable business. And so we identified there's gaps like that, there's underpenetrated segments we can go after. But I think what's interesting about MENA is that the core markets, GCC, we are primarily focused on Saudi Arabia and the UAE. It's dollarized economies. You have no movement in terms of FX, which all of our investors like, and we like that. If we have an option, of course, and so that's great. And you have relative stability. You have some sort of consistency around what's happening in terms of kind of government decision making. Everything there is run like a corporation. It's run like a business. And there's predictability in what's happening to us. It's always relative. It's not 100%. And so that's where we look at. That's where the kind of opportunity is unique, I think, in MENA right now, and why we've totally focused on our kind of.
But it also sounds like you've been riding a little bit of the momentum that's been organically created just through the macro, right? You talked about how the sovereigns have basically wanted to pump money into the local economies to support them. In essence, you're raising locally to deploy locally. We've seen our friends at Partners for Growth do something similar where they've raised dedicated GCC only funds from dedicated sovereign and other family offices locally to deploy locally. I'm going to jump to Lorena here because Alaya is an allegory. It's actually pretty. There's a lot of parallels there with VentureSouq in the sense of you're heavily LatAm focused. You're raising your fourth fund now, right? Congratulations on that. You've been investing since 2011. You've got over 60 startups in your portfolio. You're obviously super heavy LatAm focused. But so I want you to talk through that. I want you to talk through like how you evaluate your companies. Do you talk to LUCHA and others as a source or feeder to get to evaluate? But what's also I find interesting, particularly in LatAm, is we have not seen the same level of sovereign wealth and large traditional institutional investors like pension funds, life insurance companies support the local fintech ecosystem through venture and or private credit funds like we're seeing in the GCC. Like if you look at the LPs in Suneel's fund, it's like the who's who of every major family office and sovereign wealth fund that is supporting the local region. But I don't know if we're necessarily seeing that kind of level of LP support from LatAm. What would you say to that?
Yeah, I think you are absolutely right. I think that's what LatAm lacks.
Yeah.
And founders, of course, financing companies in early stages. It's something tough for everyone. The fundraising, it's not easy to fundraise in early stage. But I would say there might have been 150 early stage funds.
Yeah.
At the beginning. But then when you want to fundraise, you're following serious. There's still a lack and there's a lot of room to create new funds to invest in these companies. But even though that's not clear yet, I might say I have been investing since 2011. When I started investing, the whole amount of venture capital invested in LatAm, including Brazil, was around $40 million in 2011. $40 million. It's not around it. The ecosystem didn't exist.
Yeah.
And even though we had a high 2000 like whole world experience, now with the amount of money invested in companies, it's around $4 billion. So I think that there's a path where we need to solve as investors. There's no much institutional investing, but I think that's going to change in the following years. The market is there, it's huge.
Yeah.
Digitalization has increased in an amazing manner. I think that's the chaotic life we lived during pandemic. Gave us that gift. SMBs went digital, people went digital, the infrastructure is there, the usage of internet is comparable with developed markets, and the experienced entrepreneurs we have in the region are amazing. And they are very efficient in the use of capital. So I think that's going to change. The future is not really clear right now, but we are now seeing results. And when you compare emerging markets, what these founders have done, it's incredible with the scarcity of capital that we have right now. And I think that lending, it's some of the ways companies will continue seeing in a way of financing, not only with equity, but also with lending.
But to be clear, you're raising a fourth fund, and when you're doing your marketing, obviously you're going to some of your existing LP relationships that have been supporting you on your earlier funds. But are you seeing any interest from local LatAm, more traditional sovereign pension funds, guys that were not earlier supporters of this ecosystem, express interest now in coming into your fund, your fourth fund? And do you see that as a bellwether for what you're seeing in terms of the growth and support of the LatAm fintech ecosystem?
Yes, what we are seeing are institutional, local investors creating fund of funds.
Yeah.
In Peru is an example. Chile has created several years ago.
Yeah.
So we are looking at local governments and financial institutions taking a look at investing in this asset class. And we are also seeing some institutional, international investors taking a look at LatAm.
Japanese? You seeing any Japanese?
I'm not seeing Japanese.
How about Middle Eastern?
We are seeing very investors taking a look and understanding what LatAm is as an opportunity, but we also need to build that relationship. This is a trust investment and a long-term relationship. I've seen more interest than what I've seen in the last 10 years. I absolutely.
Sebastian, you at Accion, you're leading the charge on the LatAm side. Do you share that same outlook from Lorena as it relates to support from LatAm-based LPs? And I want to hear a little bit about what Accion's experience has been in that respect, but also let's tie it all back to LUCHA and not greenwashing and how you're looking at, because you're all, I think among of all the panelists, Accion's probably the most, I don't want to misspeak if you use this as well, but you're definitely purely social impact, ESG only investments, right? We'd like to, do you often collaborate with LUCHA and others similar, and how is that feeding the whole LatAm ecosystem?
Yeah, for sure. Happy to talk a little bit about this. At Accion, we focus on early stage investments in the financial inclusion space. So yes, we 100% have this impact mandate. But the reality is we are a traditional VC in the sense that we look for market-based returns. We don't think there's necessarily a trade-off here between social impact and market returns. And what we believe instead is that we have the ability to focus all of our time on fintechs that are addressing the mass market, being consumers or MSMEs. And we believe there's a tremendous commercial opportunity there. So we put our blinders on to anything that's not working with this long tail, and what we want to be is the best partner for founders that are targeting this market. And we do this by investing at a global scale, testing a bunch of different models, and I think similar to you, bringing those learnings to our founders. And a lot of our investment strategy hinges on being quite active post-investment. About half our team is dedicated to what we call our portfolio engagement team, where we are working with founders, closely helping design new financial products, helping them bring learnings from other companies in our portfolio that have scale, and taking them to this next stage where they're ready to fundraise maybe a Series A, for example. And I think that has resonated, maybe going back to your initial question, quite a bit with a diverse LP base. I think Accion has matured from initially being a kind of balance sheet vehicle, completely funded by Accion, the nonprofit, to now being a traditional fund that raises capital from LPs, both LPs that are impact driven and care a lot about our mission, but also LPs that just want broad emerging market fintech exposure. And I think then we're seeing a lot of interest. I think today most of our LP base is not actually regional focused. I think it continues to be based on places like Europe or the US, but increasingly we're having conversations with local LPs who see the track record we have in our regions and are interested in joining. I think sometimes what scares a little bit local LPs is that they don't want this kind of broad-based emerging markets exposure. They a lot of times want to diversify their risk, so they're not looking for maybe more emerging markets exposure. They want to put their money. Usually, LPs are making their money out of LatAm, so they don't seem necessary to take additional LatAm risk, and I think it's a little bit of conversation to be had. But I think ultimately we're having quite a bit of success, really helping transmit how working with this long tail is a new business opportunity, something that's currently underexplored in the market, and where we think we can really help founders get to the next level.
Okay, so we're coming closer to the end of the panel, and I think we're going to use this now to just ask some broad questions of the panel. Please chime in, almost a little bit of rapid fire, as it were. Let's talk about general VC fundraising climate in 26. What's the outlook for, obviously, Alaya's in the market right now. I'm sure others are looking to raise. We've seen ups and downs in global venture funding recently. Do you expect investors to be more cautious or more enthusiastic in backing fintech lenders next year or this year? How should founders adapt their fundraising strategy? Where will it be more local pools of capital or more international? Any tips on weathering a tougher fundraising climate versus taking advantage of a bullish one? So open it up to the panel and let's chime in.
Yeah, I can go first. So I think 2026 is actually going to be great to be an investor. There's a lot of opportunities out there. I think there's a backlog of potential IPOs. We're seeing in Brazil that have filed for IPO. So I think if we see that unlock, we might see the growth capital to international investors come back. That's TBD. But I do think it should paint a better picture than it has in the last couple of years from international investors, right? I think the local funds are still going to be active. I do think I'll speak to Latin America specifically. In the last 2 years, we saw a lot of local funds go out to raise, struggle to raise. So I think local capital has been relatively dry in this space because they're holding on to their last couple of investments. But hopefully, it's a whole chain. So hopefully, as IPOs happen and liquidity unlocks, like more funds are able to raise as well on the local side.
For the first time in 2 or 3 years, I'm a little bit more optimistic because I think we are cheap. The sector is cheap. You just mentioned before AI. This is not cheap.
Yeah.
For a good or bad reason, but this is not cheap.
Okay, so this is the rapid fire question for everybody now. This is, what is the ARR multiple? This is a big bailiwick for you. What's the ARR multiple that you're looking at when you're valuing at seed stage, and why is it going down in A? Go ahead, Brian. You should.
Yeah, so
This is a huge issue.
This really depends
I'll
on.
come back to you.
It really depends on what sector you're in.
Yeah.
Okay, so I do a lot of stuff.
AI is 40x ARR, which is ridiculous.
Look, okay, so if you're at Y Combinator, you're investing in anything, you're going to get some ridiculous multiple, right? If you're in AI, you're going to get a ridiculous multiple. If you're in fintech, the world splits into a couple different pieces, right? If you're an on-balance sheet lender, one of the reasons I'm so interested in this sector right now is because the multiples look low.
Yeah.
Right? You know, it looks
1.5, 2x for direct lending businesses.
I've seen things raise as high as 5 or 10, but yeah, it's low.
Yeah.
It's low single digits. If you look at payment companies, you're still seeing 10 plus. But I think there's a lot of value there. I think that's one reason to actually be looking at the space right now.
Which is your point.
And not chasing not chasing the AI companies.
Yeah.
Totally agree.
But I think it's also important to just stop and dwell on that for a lot of the early stage founders in the room. Let's not be disillusioned, because we see a lot of early stage founders compare themselves with Nubank. You're not all going to be Nubank, sorry, and those multiples. And so I want to hear others. What is your view on this? Because it's interesting, because seed stage founders come out and they raise at these much higher multiples, then they get to A, and then the multiples shrink. And then you got a bunch of seed guys, including Brian, and I'm sure Redwan and a bunch of others who look and we're like, why did I invest in seed
Yeah, so
stage?
I elaborate for one more second. So this is a huge problem for me, actually, right?
Yeah.
Because I invested the seed through early Series A. And through experience, I found that you invest in a company at seed, right? And then you invest in a company at Series A, and if they're an on-balance sheet lender, a lot of times your multiple is 1, right? Because the thing compresses. So, I mean, that's an issue. I don't know exactly how to address it, but I would just say seed investors who have been in this game for a while are going to have that view that you have to explain to me how at Series A this is going to make sense and why I don't just wait for the company to be de-risked and invest in Series A.
Yeah.
From a Middle East perspective, we're not seeing the drop off until about Series B. And for us, it's very much our region is split between kind of GCC leaders like Saudi and UAE, and then you've got the kind of lower GDP per capita, but higher kind of long tail markets like Egypt, Morocco, some of these, Pakistan, if you include that in MENA. So we're not really seeing the drop off until B. But what you're seeing incredibly high valuations, particularly in Saudi, because that's where all the international investors are going. And it's creating this, I wouldn't say a bubble, because the opportunity set is huge there as well. And we think about very quickly, we look at Saudi, why it's so interesting. It's not just the economic opportunity. It's not just deregulation across this massive economy. It's like a cultural opening. This is a place that didn't have movie theaters 7 years ago. Women couldn't drive 15 years ago. So it's a once in a generation opportunity from our perspective. So there's going to be premium pricing on that for the best founders. And if you're a smart Saudi founding team, you know you're going to get that money because there's sovereign money, there's international investors, there's local investors. So we're seeing it very high at seed, and sometimes you got to pay the premium pricing to get into those deals. But it carries on at A, and then you do see a slight drop off at C.
So it's actually interesting because it's quite contrasting. When Gregoire says it's cheap right now, it's cheap outside of the GCC. It might be more expensive from a multiple perspective, but in the GCC there is more scope to actually scale up and exit than there is in some of these other geographies. So maybe you're paying the premium on the ARR multiple in your region, but you actually will get paid it anyway because it's more likely than not that you'll get a successful exit.
Yeah, and also particularly in Saudi, because everyone's talking about Tadawul, the stock exchange there is completely deregulated.
Yeah.
It just opened up to foreign ownership. It's going to start February 1st, where foreigners can own stock directly. These are all things that you just take for granted in other markets, but it's just opening up. And so now
Still no securitization there.
It's not yet.
We've been having multiple discussions with your compatriots in Saudi that they need to pay the same attention they're paying to the equity markets to building a local securitization market in Saudi. So
I want to add something. I
Sure.
believe that it's not cheap yet.
Yeah.
Investing in early stage in Latin America. We almost didn't invest in 2024 because valuations were
ridiculous.
ridiculous.
Yeah.
And if you are not an exponential company, and even though if you are an exponential company, in Series C they will pay 10x, no, not more than that.
Yeah.
So I don't think it's cheap yet. Perhaps valuations will decrease this year because the dry power of early stage venture funds are getting smaller. But I think that's a challenge we have in the region.
But
The exits. don't
This is really
compare
interesting
with
to
the-
mention
with-
too, because when we rock up with a term sheet to a platform that might be at seed or pre-series A stage, and we tell them, look, we're going to turbocharge the growth of your loan portfolio. You probably have to raise a little equity alongside this because we need to make sure that your balance sheet is strong enough. You need to be able to still contribute the first loss to scale up so you can make more net interest margin. And then 6-7 times out of 10, the founders, they have this overinflated sense of ego where they think their business is valued greater than it really is from the perception of the VCs. And we constantly tell them, get off your high horse and just get the equity so that we can get going because you'll make it up in the later rounds. I would love to get your perspectives on whether that is faulty advice or good advice, or do you support that? Do you think that honestly?
The advice that I try to give people is valuation matters for what your cap table is going to look like, right? You can't issue at such a low level that your cap table is going to look like a mess, such that if you really are being successful, you're going to have a hard time raising because it's just going to be out of whack, right? But if it's not going to be out of whack, the main idea is you have to get enough capital to get the thing moving. I did just want to add one more thing in here about this whole cheap, non-cheap thing, which is that I hope we'll talk a little bit about like risky jurisdictions, non-risky jurisdictions, and how we think about that.
Yeah.
I just want to add something.
Yeah.
I think it's more about that exit strategy than valuation you're actually entering.
Yeah.
That the biggest problem in Latin America is that there's no liquidity. So I just tell it to myself, I never have I ever entered a cap valuation. Never. If they're raising at 8 million, I'm not going to invest at 8 million. I'm I'm gonna invest at the valuation and I feel it's worth. So I never enter the valuation they're raising. But more important than that is how I think it's gonna exit. You're not gonna get acquired like by Meta or by Google. It's not gonna happen. I'm sorry. So you have to have a good exit strategy. So for me, it's more on that side. I think a lot of valuations are actually believable, but you always have to negotiate and pay whatever you feel it's worth it. But there's always one VC that messed that up and invest at a ridiculous valuation and messed around for everyone.
Yeah. Anybody got any response to that on the panel?
No, I actually think that raising too high is worse for everyone.
Yeah.
Because I think at the end of the day, especially early on, like it's good for your ego, but at the end of the day, at some point, you're not gonna grow into that valuation. And so for you, you're holding a bar of I can't raise unless it's worth X in your mind. And at the end of the day, it's hurtful for everyone because then it looks bad for the VCs if you're trying to do a down round, right? And so I just think it's the principles-based investing in VC is you raise for the milestones, you raise the amount that you need to learn what you need to know by the next round, right? And so instead of anchoring to a valuation, like think about the capital you need. I think it's great advice what you give. I give similar advice to my early founders is let's not optimize for valuation because at the end of the day, if you're able to 10x from here with a lower valuation now, you're going to be at a much different point like, in a year.
Exactly.
So, yeah.
What I like to tell them, also the founders, is that, okay, the valuation might not be great now, but you take some more options. So that's their role also to get accepted a better option 2 plan or whatever that mitigates this probably low valuation you want to, because you said that in mind, but valuation should be that high.
Yeah.
I don't raise by the sake of raising.
Yeah.
I have a lot of founders that I ask, how much are you gonna raise? $500,000. Why? Because we're at that stage. What's 500K? You have to know why you're raising and for what and what are you gonna accomplish with that money. How much of the dollar are you gonna get from the dollar you're raising? So don't raise. You already interrupted me.
No, it's fine. Sorry about that. No, I agree. I think for us, one thing I would like to note is that we are seed-stage investors primarily. We are seeing the milestones for Series A change drastically. It is harder today to raise Series A.
Yeah.
We're seeing valuation rates from seed to Series A fall quite a bit.
Yeah,
So
like this whole idea of pre-Series A is now, it's becoming its own round. Like, it's ridiculous. You have seed, then you have seed extension, then you have pre-Series A, and then if you're lucky, you get to the Series A, right?
Yeah, so I think for us, we advise founders to be very conscious of these milestones, raise enough money, try to avoid raising consistent rounds. And that's why I think this exercise is complex, right? Because we're
Take the mezzanine for point, right? Less equity.
We're seeing this, it's a complex environment. We're seeing maybe multiples come down, but the reality is you need now more money and you don't want to over-dilute yourselves. That impacts valuations upwards. We're seeing more crowding in given these lower valuation rates, and that also pushes valuation upwards. It's a complex system. I think our advice for founders is optimize for raising enough money to get to the milestones you think for a Series A, consistently be talking to investors in your next round, making sure you're hearing from them what they're looking for, and plan quite a bit and give yourself enough of a buffer. It's okay if you over-dilute yourselves maybe a little bit early on. That's better than the alternative of having to consistently do emergency funding rounds.
Okay, quick rapid fire. Hottest models versus cautionary tales. What are fintech lending? Fintech lending has many flavors: digital banks, BNPL, embedded finance, SME financing, trade finance. Which of the specific fintech lending models are you guys most excited about in 2026? And which ones are you not so hot to try on? And then, since we're coming close to the end, we want to also open it up for Q&A. Give us your bold prediction also at the same time. So let's go down and down. Great way to go first, we'll go all the way down. So what do you think's hot for 2026? And what is your bold prediction?
I'm still hot for payments. I love that. I love the scale you can achieve with that. And on off balance sheet, I'm more geared toward off-balance sheet lending. Bold prediction, we're gonna have a good year.
I think for me, the model is more sort of business, B2B lending, especially in Latin America, which is most of what we've done. And on the flip side, less interested in consumer and especially more kind of micro lending, which is not really just more for our fund. It's not what we're looking for. And then predictions, I do think we will see the IPO market open, which is optimistic, but I feel good about it.
Crossed?
Yes.
Yeah.
Presumably, the Brazilian IPO is one of your portfolio companies?
It's not actually,
Oh.
but
Yeah.
it's gonna open the way
Okay.
for ours for sure.
I was rooting for you.
Yeah. Yeah, but I think I can't not say AI, but I do think AI is going to see a massive impact in some of the models.
And we have a great panel on that later in the day. We're going to get into that.
Yeah, and stablecoin infrastructure.
Yeah. Brian?
Yeah, prediction. So if you look at Goldman Sachs and Morgan Stanley's last earnings report and look at the investment banking advisory line, it's through the roof, right? And that's the first time in years it's been down, all the bankers are miserable. It's up huge, right? That means IPOs are here and they're coming. And that has been the whole clog. So my prediction is the IPO market's going to be hot. That's going to give a little bit of leg to the whole venture thing. So I'm excited about that. And I'm from that world, so I can see it. And I saw it when it was going the other way. The models I really like stablecoin infrastructure. I've got some investments there that are doing really well. Credite, one company that's in the news a lot right now, Contigo, which is a lot of fun right now. And another one, Gokhale, which is rebranding is Ruvo. And then on the lending side, there's kind of two models I like. The one model that I like is embedded lending when there's really something else going on. I like this in vehicle finance and other things along those lines. I do like BNPL. There's a company I'm in, it's a Venezuelan company called Cachea, and if you don't know about them, you're going to hear about them.
Yeah.
Right? It's the most
Cachea is
unbelievable story I've
everywhere.
ever seen. And just a quick pitch, like if you want to have good returns, you have to look where other people aren't. You can chase AI, or you can look at where stuff is distressed and where it's risky and where people don't want to do it. Venezuela is one of those places, and it's all because LPs aren't going to tolerate OFAC risk. And some people just don't want that risk, but it's mainly about OFAC because people haven't read the rules.
Yeah, I told a story to Brian early this morning. At SixPoint, we were no-fly zone on Venezuela up until the moment that Donald Trump stepped up to the podium at Mar-a-Lago 2 weeks ago. And I'm sitting there, my wife, my kids in the living room, and I'm looking at the screen, and I'm literally WhatsApping my partners, and I'm like, are we going now? And immediately they hadn't read the news, and they were like, no, AJ, stop pitching Venezuela. And I'm like, come on, turn on the TV.
Yeah.
And then there was like a 3 or 4 hour digestion period with my partners. And then like later in the day, I got like a one-liner from my co-founding partner. Yeah, we should probably start having conversations now. So Venezuela is open for business for us.
Yeah, it's open for business. And again, I'll just mention
Argentina is another one.
They built the only functioning consumer credit in the entire country, and it's unbelievable. So yeah, those are my picks.
In terms of predictions for MENA, we're optimistic. We're expecting a flagship IPO to happen this year, which will be big for the whole ecosystem because it's the first time it'll be in Saudi. Hopefully, it's one of our portfolio companies, but this will be important. There's been, of course, Saudi IPOs before, but this will be the first time that the majority of money is going back to non-Saudi investors, so international investors, particularly in the US, will hopefully do very well, which should drive the market. In terms of segments, we're super excited about SME financing for reasons I talked about, and then any fintech solutions that wrap around really core segments like healthcare, real estate, construction, those things that are wrapped around that.
Yeah, embedded finance is something that we see a huge opportunity in Latin America. Regulations changing, consumers demanding financial services at the point of need, and we also have some interesting infrastructure companies creating the reels to increase the revenues of these companies.
So this is interesting. The embedded finance, I want to just pause on that for a moment. So we see two different types of, when we talk about embedded finance, we see basically two main pillars of embedded finance. We see fintech platforms like an e-commerce platform or a marketplace platform embed lending in their offering to grow GMV. Okay, they basically want to take on the role of also becoming a lender. That comes with a lot of hair with it because they're not traditional credit people and they're trying to build a credit business inside of a marketplace or e-commerce business. And it comes with a lot of challenges. Sometimes when we look at a company like that, we're like, okay, we can make this work and we'll work with them to help them build their lending business. On the flip side, we've actually seen a bunch of SaaS companies that are basically providing embedded lending as a credit as a service, like R2, for example, is an example of that. Orbi, in your geography.
We're an investor in R2.
Right.
Actually, as well.
Oh, you're investing in R2 as well. Okay, so R2, Orbi, Agua, these are companies that are basically saying to the SMEs, we'll do the credit as a service in a box. You just use it as the equivalent of a buy now, pay later or invoice financing tool. Do you draw the distinction from an embedded finance perspective? Is one better for you than the other? Would you rather back the SaaS play that's providing credit in a box to the SME, or would you rather be more comfortable with the actual embedded direct finance, direct lending that's turbocharging GMV for a marketplace business or an e-commerce business?
I think that both models can work well, and we see two different opportunities. Creating the ecosystem, owning the customer, having the data, using stable coins, using technology, using AI, agents, everything that has brought a lot of value to those ecosystems, embedding financial solutions in general. And the other kind of companies are the infrastructure companies that can connect these worlds, and every company will find what's the best way to achieve their goals. We see both as opportunities. We want to continue investing in this kind of companies. And the bold prediction, I think we will see more exits, more DPI in the region. The ecosystem is maturing. Entrepreneurs are going to merging and going to preparing their companies to M&A. And I think that LatAm is at the spotlight.
Right.
So we will see more exits. We need to be patient, but I think that we will have not only perhaps IPOs, but also...
What about consolidation, rolling up within LatAm?
I think that consolidation...
Competitors buying each other.
Absolutely.
Yeah.
But also strategic acquirers.
Yeah.
Technology is a need for huge corporations.
Yeah.
Entering into these kind of fragmented markets, it's also very difficult. So I think that we will have more news about these M&A sections in the region.
Prediction, 2026. What models do you like?
We don't like trends, so I'm not gonna comment about
Okay.
trends. We like markets and impact. So whatever financial inclusion means and scalable impact, that's the way we like. Also, I like on a personal side, micro lending. So I'm buying a micro lending company right now, not with Lucha, but on my, maybe next year I'm gonna be sitting there asking you for that.
Talk to me. We'll make it happen.
But yeah, we're looking at financial inclusion, just not another credit card piece.
Yeah, I think for us, on the lending side, we continue to be excited about embedded lending. We think that's the best way to get to these long tail of consumers. For me, the more broken the value chain for MSMEs, the harder it is to underwrite them, the more excited we get. So if you're working in industries with long tail of MSMEs that no one wants to lend to it, I think that's the best place to be at. And I think from a bold prediction, I think we're continuing to see AI be a great tool to gain operational leverage. It's making sales easier, it's making collections easier. And we think this can be a tool that can bring back maybe boring businesses or businesses that were not as attractive in the fintech space before. So we expect to see growth in insurtech and maybe in savings products, those kind of things.
Great. So this is the end of the panel. We are running a little bit over, but I definitely want to give folks in the audience an opportunity to ask me one or two questions. Who's got? Anybody got? You've got one?
I do.
Okay, go for it.
So I know obviously we're talking about early stage investing, but I'm sure that some of your
It's growth.
some of your earlier vintages are probably seasoning to a point where, it was touched upon, and I think Lorena mentioned this, there aren't that many strategic exit opportunities in Latin America or some of these smaller EM ecosystems. And if a public listing isn't your path, and as you said, not every company is going to be a unicorn, right? What are you advising your earlier, later stage companies, earlier vintage, later stage companies to doing? Is this strategic acquisition? And I'm thinking more lending businesses themselves.
Yeah.
Are the banks interested? Is it more family office? Is it private equity? Like, where are you seeing those exit opportunities, and what are you suggesting?
And also, are you getting pressure from your LPs to find a liquidity event?
That too. Exactly.
Anybody got anything you want to add on that?
I just want to add one thing. I come from private equity before, so my mind goes into what's the exit strategy when I invest. So when we just partner with one startup, is let's work from day one on your exit strategy. So we're planning and knowing about all the players in the field that actually can be potential buyers, and we start doing an ecosystem within them. So I think, for Lucha, is our mandate to create that ecosystem of exit. I don't know what you guys do with the exit, but that's how we actually can have a certainty for the exit path, because as I said before, liquidity is one of the biggest pains in Latin America.
Anybody got anything else?
Yes.
You, sir, Alex?
Yeah.
Alex Rodea, by the way, deep ocean. Over there in the corner.
Right. I would add that perhaps we don't have the answer yet, but in the industry, what we are talking about is that we are going to find new companies where profitability will come earlier than we've seen before, and we will perhaps invest in the future in smaller teams with more profitable business that doesn't need that amount of money. So this is something that doesn't exist in the industry, but this is a discussion we're having among some investors, that we historically invested in companies to invest now and sell the company or sell our position in the near future, 15 years. Perhaps the model will start changing for some companies where profitability comes, where they become huge companies, but without the need of selling in the short term. So this is an open discussion. I believe that perhaps we'll see what happens this year or the next one. I think we will discuss these kind of models and how to structure venture capital traditional investment. At least in Latin America, it's a challenge we haven't had. And I think that it's a discussion we are having with our LPs and among us as investors and with some entrepreneurs also.
So it's not an exit per se, it's a business becomes profitable enough that you can start getting liquidity through dividend distributions.
Yes, the model itself, right now, it's not thought
Yeah.
that way.
Yeah.
So there's some contradictory
Yeah.
behaviors when we invest in these kind of companies that it's, in my opinion, it's not healthy in the long term.
For EM lending companies, there's 3 red flags for me. The first one is you're doing consumer lending and you say your defaults are 2 or 3% less than the US credit card lender. The second one is if your net interest margin is really thin. And the third one, this one, some people may will think this sounds naive, is if you say the word exit to me, right? Because you can't build a huge company, I don't think, if you're already thinking about an exit. So I have yet to see a wildly profitable, scaling company with tons of EBITDA that can't figure out how to exit. So I completely understand the question. In lending companies, I think that's one of the main reasons why their valuations are depressed, is because people can't figure out. They're like, I haven't seen one recently get purchased by a bank, or exactly how's it going to work. But I think that's almost like who was the last giant lending company that had giant margins that was piling up profits? They couldn't figure out what to do with itself. So that's not really an answer, but that's how I think about it.
Anybody got anything else on that? Or we'll make time for maybe one more question. If anyone's got a burning question.
Yeah, no, just a quick one on the technical side. I hear you talk about stablecoin in a positive way, and I work for Gasman called Gokhale, and we provide lending solutions to companies in LatAm and Canada. We partner with banks and these, and our platform runs on blockchain, and you can use the tokens or fiat or stablecoin. In Canada, we use QCAD, which is a very understood. But a lot of VCs and PE funds said, stay away from stablecoins, stocks, like they didn't even mention that in the pitch. Do you guys see that there's more adoption now, more comfortable, or? Yep.
Okay. Yeah. Look, the world economy is over $100 trillion. $1.5 trillion of that is being spent on payments. That's wildly inefficient. It's the biggest disruption target, I think, on planet Earth. There are all kinds of problems with stablecoins. They can be used in capital control regimes to dollarize stuff, and if you dollarize the local wealth, and if you do that, you're going to find the regulators. There's not a lot of regulation around it. But it's, to me, it's like looking at like New York City taxi medallions and Uber. You're like, yeah, they're probably gonna get a couple red flags thrown at them, but it's so obvious that this disruption is coming that it's just, to me, it's, if you miss it, you're missing this massive disruption opportunity.
And I do think the narrative has changed on the VC side, especially with the regulation in the US, in Brazil, there's the stablecoin law. Like, with it becoming mainstream, it's definitely, from my perspective, the VC world is very attracted to stablecoin right now.
We should talk later.
Great. Anyone else? Give it up for our panelists. Thank you very much.